Taylor theorem is a central assumption that we are using, right, for for valuation, right? Theorem on those of you, right, have taken course theorem on capital structure. In an efficient market with no taxes and bankruptcy, the value of the firm is unaffected by how that firm is financed, right? So when we are doing valuation at a DCF or a multiple of EBITDA, we're arriving at an enterprise value, right? What we are saying, once we get to the enterprise value, then we apportion that enterprise value based on how much debt and equity is there. But it's important to understand, right, that we're getting to the enterprise value, the market value of debt plus the market value of equity. So we are indifferent as investors between debt or equity. So the enterprise value of the firm is unaffected by how that firm is financed. Critical assumptions, which may come up in interviews, right? The firm's cash flows are still equal to the cash flows of the project. Present value of the cash flows have not changed, not dependent on how the firm is funded, right? So the total value of the firm is unaffected by how it is funded, essentially what we are saying. So the total value of the firm's securities is equal to the market value of the total cash flows generated by the assets and is not affected by its choice of capital structure, right? Capital structure does not impact how we value the company, and this is a critical assumption using a DCF or an enterprise value to EBITDA. When either approach, we are solving for the enterprise value. By definition, if that's the case, then the value of the enterprise is unaffected by its valuation, right? When we value a company, we focus on the enterprise value of the company. Market value of debt plus the market value of equity. How a company is capitalized has no bearing on its valuation. Critical assumption when valuing companies, we solve for the enterprise value of the companies using projected cash flows. Then we allocate the value between debt and equity holders based on the capitalization weightings. And it's important to note that a WACC that we do does incorporate debt is used for the cost of capital, right? So the WACC that we are using, our cost of capital, is impacted by how much debt they have in the balance sheet. If you look at the market value of equity plus the market value of debt, the market value of equity dominates most companies' capital structure. And also, it's very hard to materially lower a company's cost of capital through debt issuance. And if we look at post-2008 financial crisis, most companies have become risk adverse, and debt today is a smaller percentage of their capital structure, right? So you've got to ask yourself, right, why do some companies have a lot of leverage on their balance sheet and others, really don't have that many, right? If companies, one of the things that you learn in core is if companies can add value by adding debt, why do some companies have net cash on their balance sheet? And why are the companies that are the most cyclical have more debt than others, right? Why do companies, with a strong competitive advantage have net cash on their balance sheet? And how do you explain companies with the least degree of volatility in their cash flows being the least leverage, right? So that's what's going on with when this, again, could come up with an interview question, right? It all has to do with their returns on invested capital, right? Which we talked about a couple weeks ago, right? It is the spread between a company's ROIC and the cost of capital that drives value creation. If we have very high returns, right, there's less of a need to use leverage to drive WACC lower, right? Our returns are already gigantic. If our company has a low return on invested capital, we need to have capital, more debt on our balance sheet to drive WACC lower, right? It is the excess spread of returns versus the WACC that results in value creation, and it explains capital structure. So just quickly, here we have Apple, and this may be probably dated for not the most recent balance sheet, but Apple has net cash on its balance sheet. Google has net cash on its balance sheet, right? $124 billion when this slide was done. Amazon has $53 billion of net cash on its balance sheet. Nike has net cash on its balance sheet. American Airlines is loaded with debt. Well, what explains capital structure between all these companies? Well, Nike, Amazon, Google, and Apple all have ROICs that are very high. There's no need for them to add debt to lower their weighted average cost of capital, right? Because their ROIC is so high, adding incremental debt is really not going to drive that WACC or that spread between ROIC and WACC. It's not going to really move it. Where American Airlines, if your ROIC is 11%, the difference between 11%, if your ROIC is 11 and your cost of capital is 9, if you can lower that cost of capital by 50 or 75 basis points, you're going to increase that spread between the ROI dramatically, right? But if you're Apple with an ROIC of 200%, if you take your ROIC from 8 to 7.5%, who cares, right? That 50 is not going to dramatically, that spread between your ROIC and WACC is not going to drive that much in the way of shareholder value, right? So it's the companies that are in their kind of the worst businesses need a lot of leverage on their balance sheet to drive that spread between ROIC and WACC just to maximize, because the returns are so low. But if you think about it, it's kind of nuts, right? These are the companies that really can handle more debt on their balance sheet a lot, not as well as companies like Google or Nike, right, where their business models can handle the debt. But it kind of explains why certain companies are levered and other companies have no leverage, why other companies have no. Now, Google, right, super smart people who run the company, right, they have net cash. Are they that stupid, right? If you could add a lot of value by adding debt on the balance sheet, why do they have net cash on their balance sheets? Because their returns are gigantic. They don't need to. Again, I apologize. We got a lot to go through, all right? So we look at equities versus bonds. So now we're going to be doing the DCF approach, all right? And then we're going to do the EBITDA approach next, right? Equities versus bonds, right? Equities are owners, right? Residual claim on the firm's assets. They only get paid after the debt holders get paid. So equity holders, right? They basically receive dividend or cash only after the bondholders get paid. And we also don't know exactly what the size of the coupons are. Where bondholders, right, they get paid first, right? And we know that essentially the size of the coupon payments, right? So bonds are less risky than equities are. And as a result, bonds, right, they get paid first and the equity holders get paid after the bondholders. And this explains why bonds have a much lower beta than equities do. We know the size of the coupon and bonds actually get paid first, right? So a way to approach a firm is to calculate its free cash flow, right? And this really measures how much cash, that the firm generates after, all the capital that is required to actually generate that cash flow. And so we measure free cash flow by revenues less costs, less taxes, minus cash flow adjustments, which are depreciation and amortization, working capital, and capital spending. And it's important to note that this free cash flow that we're generating goes to both shareholders and debt holders, right? We are solving for the enterprise value. So, and important to point out is that if we look at the value of the enterprise, it is driven by the company's free cash flow going out over time, right? So what does that say about value creation for a company? The only way you can generate value is at some point in the future, this company has to generate free cash flow. It's important to really think about that. So companies that are perennially losing money, unless they can somehow get to being free cash flow positive, are worthless, right? So it's an important finance concept to actually understand. So we start with operating income, less taxes, we add depreciation, plus or minus changes in working capital, and subtract capital spending, right? Important to note that we do not include financing cash flows in our cash projections, right? And essentially the financing cost, this is what's going to be paid out of free cash flow. So when we calculate free cash flow, we do not include financing costs. So who here took core? Did you guys do the free cash flow thing in midterm? Right? Who here got the, deducted interest costs on their free cash flow estimate? Yeah, so that gets usually half the class, right? So anyway, when we do free cash flow, we always do it. We do not basically include interest costs. And importantly, when we are calculating taxes, right, we calculate taxes not assuming that interest costs lower taxes. So the enterprise value of the firm is equal to the discounted sum of free cash flow of the firm. It's how much free cash flow do the assets generate, right? M&M's theory states that the market value of the firm is equal to the market value of net assets plus the market value of equity. We use the DCF formula. We arrive at the total value of the firm and then subtract the net debt to arrive at the equity value. And importantly, and we'll see this, the terminal value is really a growing perpetuity for most firms, right? So this is our, right? We take last year's free cash flow, 1 plus our growth rate over R minus G. You all remember this from 132, right? This is, the growing perpetuity calculation, right? And this is why we teach you a growing perpetuity in SM 132. This is, the formula that we use to calculate a DC, or the terminal value, right? Again, the value of the firm is driven by the net present value of the firm's free cash flow. Our cost of capital is equal to the discount rate. For purposes of solving for the DCF, we use the after-tax WACC, right? And so we can drive this lower by the amount of debt on our balance sheet. And again, interest expense is excluded from the cash flow calculation. They have a claim on the free cash flow, right? Once we solve for the NPV of the firm's future cash flows, we subtract out the amount of debt. What is left is the equity value, right? And again, this explains why debt has lower volatility and it's less risky. So just to review our WACC, right, we have two components of cost of capital, debt and equity. We need to estimate both to arrive at the cost of capital, and we look at the capital markets to guide us in determining the appropriate cost of capital. So for WACC, or for the debt side, we use the company's yield to maturity, right? So for purposes of your project or whatever, I would just use 5.5%, and that's the pre-tax cost of debt. You can go to, if you really want to be fancy, go to a Bloomberg terminal for your company and look up its yield to maturity and long-dated debt. But for my classes, yield to maturity is a reasonable estimate of the debt holder's expected return, right? It reflects, it's a market view of the company's creditworthiness, right? And so we want to include this. So companies that, are deemed to be high, high creditworthy, right? They're AA or AAA rated. Their yield to maturity is low. This impacts our cost of capital, right? We're assuming that markets are, efficient, right? And so. And also, right, when we are looking at, the yield to maturity, it incorporates two things. A, the market's perception of the creditworthiness of the company, and B, the interest rate that you issued the debt at 3 or 4 years ago, interest rates change. It also reflects the current interest rate environment. So yield to maturity is what we use for the debt cost of capital. And again, for purposes of if you're doing this, and you're going to estimate the value of your company, use 5.5% pre-tax. We use, right, the CAPM to estimate the company's, equity cost of capital. Today, the market risk premium is roughly around 4%. So I use an 8% return on market and a 4%, risk-free rate. And you look up your company's beta. And you can Google it, and I like to use a couple sources just to make sure I'm close to I get the same answer. And this is how we estimate our cost of equity capital. And then we calculate the ratio of net debt to the total capitalization and the equity to total capitalization. And then we multiply this by the after-tax cost of debt and our cost of equity to get our WACC, right? And when we are calculating net debt, we need to understand net debt is short-term debt plus long-term debt less cash, right? And so net debt reflects total debt less cash, right? For the equity value, we look to the publicly traded stock price, get the number of shares outstanding, multiply by the shares outstanding to the current stock price, and then we get our market capitalization. And so in terms of determining the net debt ratio and equity ratio, right, they should always sum to 1. So net debt, we calculated from the balance sheet for the most recently reported fiscal year. So for your companies, you should be using your 2000, the year's almost over, so you should be using, and purposes of this year, your ending 2024 estimated balance sheet, right? Use shares outstanding for the income statement for the most recently reported year. And we're going to, again, subtract net debt to arrive at the equity value. So for purposes of this, we want to make sure net debt and shares outstanding are as of 2024, based on your forecast for 2024. Now, if we were doing this project in March of 2025, you would use reported results for the end of 2024. So your models, if you've got them, are set up to calculate the DCF, right? They contain the inputs necessary to calculate it, right? Operating income comes from the income statement. Taxes, use taxes for NOPAT. Change in net working capital comes from our funds flow statement. Capital spending from the funds flow statement. Our WACC from our cost of capital analysis. The growth rate I'll get to in a second. And the net debt and shares outstanding come from the income statement and the balance sheet, right? So your models are set up to easily populate your free cash flow, your free cash flow estimate. So we start with the operating income, right? This is our first place in calculating free cash flow. It is accounting profit that needs to be adjusted to reflect the cash flows of the firm, right? Taxes, right? We need to calculate taxes independently from what is recorded as tax expense, because tax expense in the income statement can be impacted by either interest expense or interest income. So we need to calculate our taxes independently of what's reported. And if you remember from the ROIC lecture that I did, this is your taxes for ROIC will be the same for this, right? And so this is an unlevered way of valuing a company. Very similar, ROIC, when we look at it, it's an unlevered measure of a firm's profitability, right? Depreciation, an accounting concept for expensing the use of a capital asset over time, right? It is not a cash expense, so we need to add this back, right? We need to add depreciation. Net working capital, right? When we are looking at net working capital for a DCF, we first calculate net working capital, right? And net working capital for our DCF should be exactly the same as net working capital for our ROIC calculation, or for our invested capital calculation for ROIC. What gets reported on the DCF is the change in net working capital from year to year. Right? It's the change, not the absolute level. It is the change from year 1 to year 2. What I like to do is I just do a simple, I have net working capital calculated. And so if I'm calculating 2024 change in net working capital for my funds flow statement, it'll going to be 2023 less 2024. If it's a negative, you report it as a negative. If it's a positive, you report it as a positive. Students sometimes get their signs wrong, and what should be a use of cash becomes a source of cash, which is wrong, right? So net working it's required to support the business. As the business grows, net working capital grows with it, right? This is a component of supporting the business. If you think about it, if revenues grow, receivables grow, you need more inventories to support higher revenues, right? So in general, net working capital typically grows and is a use of capital as the firm grows, right? It is the change in working capital that is deducted. Capital spending, right? This comes from our funds flow statement, right? Some companies are highly capital intensive, requires large yearly outflows. Software companies have minimal capital spending, right? Higher cash flows, there's less capital support the business, right? This is why higher capital intensive companies are worth less. Why is Microsoft the second largest company in the world? Because there's no CapEx, right? Why is American Airlines not valued highly? Because there's a lot of capital required to support the business. So the growth rate, this is a critical component to estimating the terminal value. It dominates. So if we look at a DCF, which we're already in a second, the terminal value dominates the enterprise value, right? It is very hard to estimate what is the underlying growth rate, right? Very hard. Most companies today in the S&P 500, it should be between 2 and 5% for your terminal value. If you need a terminal value of 8 or 9%, there's something wrong with your model, all right? Most companies, mature companies, it's somewhere between 2 and 5%, depending on the company. And the reason is, when we're using this to, calculate the terminal value. The terminal value is a growing perpetuity. It means it's going to grow forever at this underlying growth rate, right? So just the law of, if you're using 8 or 9% into infinity, your company's terminal value is probably going to be greater than the world's GDP, right? So you need to estimate or some growth rate that is commensurate with the business, right? So companies that are slow growth, Procter & Gamble, right? Kimberly-Clark, Colgate, Coca-Cola, Pepsi, they probably would grow with GDP growth, 2%, right? Other companies where there's an underlying trend, Google, for example, you'll probably use 4 to 5%, right? Google's revenues are going to grow at a multiple of GDP. Search is still growing, right? So these are things that we need to think about. Interestingly, if you were to do this for the oil and gas industry or integrated oil, if you were to do a DCF on Exxon, the growth rate is actually negative, which is fascinating, right? It's actually a declining perpetuity. And the reason is, just think about it, there's only so much oil out there that can be discovered, and as renewables displace, as renewables, displace oil and gas, the growth rate's going to be negative. So when you do a DCF on Exxon, it's actually negative, which is fascinating. So things to consider with the growth rate, the growth stage of the company. Is this an early stage company or is this a mature company, right? Size of the company, the larger it is, the lower the growth rate should be. Is the market they serve growing? Again, very hard to have a terminal growth rate above 7%. Most companies today are between 2 and 5%, right? So terminal value is the largest component of value, is driven by both margin and growth rate assumptions, right? Formula is nice, only accurate if the inputs are accurate. Many companies do not generate that much free cash flow. If they do, very hard to materialize very far into the future. How do we value these? Tough question. So the DCF approach it's theoretically appropriate for valuing equities. It is theoretically pure, right? Some professionals use it, others don't. Over my investment career, I have never done it once. The first time I did a DCF was when I taught core 3 years ago, right? So I'm still kind of learning it. I literally, when I worked at Fidelity and on my own, never did a DCF in my life. And we'll talk to reasons behind it's not that good of a valuation measure. Issue is that it relies on forecasts that are way too far in the future from an actual cash flow generation and subject to manipulation around the discount rate, the growth rate to get the answer you want. This is why investment bankers love it, right? Because you can manipulate the growth rate to get whatever answer that you want, right? And the lead investment banker determines the valuation that you're going to get to, and then the investment all the investment bankers are locked up in a room over the weekend, and they basically manipulate the DCF to get the answer what the investment banker wants, right? So what are some issues with the DCF approach? For high growth companies, the growth rate's going to be greater than the discount rate. You're going to get an answer into infinity, right? Comparing companies on a valuation basis is difficult, right? You're going to get an answer. If you look at the household products industry, you're going to get an answer for Colgate, Kimberly, P&G, Clorox, et cetera. That tells you nothing about how company A is valued versus company B, C, or D, right? DCF works fairly well for established companies with consistent revenue streams and margins. However, the longer you have to go out, right, the greater the forecast risks, right? So these are issues with DCF. Some common mistakes that my students make. Make sure your working capital assumption for the year that you are using to estimate the terminal value is in line with the historic ranges. So look at what your working capital assumption is and compare it to history and make sure that's in alignment. Make sure your operating margin assumption is reasonable for the terminal value year. Remember, that terminal value year, your free cash flow in that terminal value year is really going to drive the terminal value. So if your capital spending was wrong, or your working capital is wrong, or your margin is wrong, it's going to drive the entire terminal value wrong, right? And also, your capital spending estimate is reasonable, and your growth rate is reasonable. As companies get larger, their growth rate is going to actually slow. So this could easily come up in an interview, right? So what is the usefulness of a DCF, right? And you can reverse engineer the DCF, right? What is assumed in the valuation? The growth rate, the future operating margin, and the capital spending. So if we know what our cost of capital is, and we know what the prior year's free cash flow actually is, we can play with our model to reverse engineer what the market is assuming, what is embedded in the company's valuation. Again, last year's free cash flow was done. There's no mystery as to what it is. It's written in stone, right? We also know what our cost of capital is. That also was written in stone. So what is left is some, our assumptions, right? What our margin assumption, our working capital assumption, and our capital spending assumption, and our growth rate. So we can tweak these to reverse engineer back to where the stock is trading today. It's really useful in understanding, right, what is assumed by the market, and are these assumptions reasonable? So if you think that the underlying growth rate for this company is 2% and the market is assuming it's 5%, that's really useful information, right? Meta, for example, to get to the DCF of Meta today, you have to assume that their AI spending is going to plateau and decline. It's kind of useful to know, right? If you think Meta is going to continue to spend at $70 or $80 billion a year, you don't want to own the stock, right? The market is assuming today that the capital spending is going to roll over pretty hard. So let us see how here is Garmin. I use this in one of my classes, right? So here's our model, right? Break it down by revenue source. We have gross margins, operating margins, right? I'm going to take this out to 2026. As you can see, 2024 was a great year for Garmin. Our margins went back up. We have our funds flow model. You can see my working capital actually comes from my funds flow statement. I'm assuming, capital spending in $200 to $250 million range. Importantly, I'm linking my cash forecast with my change in cash on my funds flow. We calculate net working capital, and this model has been published if you want to revert to it. Change in net working capital. So now we do our ROIC to see what's going on with this ROIC. And here's how we can simply calculate our cost of capital using the inputs that we have, right? So I looked up its beta, it's 1. I gave you the R sub F and R sub M. The beta for this is 1, so the cap M says it's an 8% cost of equity capital. Now, this company, Garmin, has net debt, which is negative, which means there's cash on the balance sheet, right, after debt. So our cost of capital is equal to our cost of equity capital. If there's no debt on the balance sheet, our cost of debt is zero. So in this company's case, the cost of equity is equal to our cost of capital. Now here, what do we do? So operating income, right, this comes from our income statement. So if we look here, this directly comes from my forecast of operating income, right? That comes from above my model. Taxes, we take what we think our tax rate's going to be, multiply it by this, we get no PAT taxes, and then we get no PAT for purposes of DCF, and then these directly come from our funds flow statement, right? Depreciation, capital spending, change in working capital, and now we get our free cash flow. And what I like to do is, even though we're not going to calculate, right, these, this should be 20 over to 23, even though we're not going to incorporate past year's free cash flows into our enterprise, it's nice to see this $1.5 billion against previous year's levels, right? It's kind of informative to see, am I out to lunch, or is this a reasonable number, right? So look at $1.5 billion against $1.1 billion. I mean, that's, pushing it, but it, it kind of makes sense that they, given the trajectory. And this free cash flow estimate in 2026 is what we're going to use, right, to calculate our terminal value. So what I like to do is put my cost of capital here and my growth rate here, and then I can change my growth rate assumption to see where the stock is valued, right? So cost of capital, right, that comes from our cost of capital, calculation above. Now the question is, what is Garmin's growth rate, right? So if we assume GDP is 2%, given wearables, their continued growth, the market, consumers' acceptance of them, health, fitness, et cetera, I assumed that the company would grow 2x the GDP. So I got to a 4% growth rate. So we calculate our terminal value. What's up here? Last year's free cash flow plus 1 plus our growth rate divided by R of 8 minus 4, and now we get our terminal value of $39.5 billion, okay? And then we drop it down to here, and because this is a growing perpetuity, the cash flows are as of the end of, the beginning of 2027 or the end of 2026. We discount this back to 2, this back to 2, and this back to 1. And then we sum this to get to an NPV here. And then our net debt is as of the end of 24. So our equity capitalization is $40.7 billion. We take our shares outstanding as of the end of 24, and guess what? Right on top of where the stock is trading. Like pure luck. Maybe pure genius, right? But pure luck. So that's how we do a DCF for Garmin. Any questions on Garmin? I know I'm going super fast. Let's do one for Starbucks, where I didn't get the same number. So here is Starbucks historically, right? So this is where, right, the market may differ, right? I'm negative personally on Starbucks' ability to turn around. So my same-store sales growth is not, I'd be willing to bet, what the market assumes. I also think that their margins are going to be permanently under pressure, right? This is reflected in my margin assumption for 25 and 26, right? So this is a great example, and why I'm using it is that your valuation, what you get, is purely a function of your inputs, right? The inputs drive the valuation, right? And so if your inputs are right, your valuation is going to be right. If your inputs are wrong, then your valuation is going to be wrong. So again, we forecast the balance sheet, our funds flow. It all drops down. I used a beta of 1.06. This company actually does have some net debt. Again, for purposes, I used a 5.5% yield to maturity, the net debt weighting, the equity weighting. So here is my cost of capital of 8%. So here's our DCF, right? Now, in this case, if we look at the variables, depreciation, capital spending, and working capital, these are not huge, leaps of faith. And this is what's good about, looking at it going back over time. My $1.65 billion is probably reasonable, as is my cap spending, as is my change in net working capital, right? These are all reasonable estimates. So now, here's my free cash flow estimate for 26. Well, what's really the big driver of this? It is my operating income number, right? This is the big driver of it. So here, I assumed a growth rate. You can argue this is wrong. It probably should be lower, but of 5%. So now I get my terminal value of 110 billion. I get it for 25 and 26. Again, discount it back to the power of 2, power of 2, power of 1. We get 99 billion. We subtract net debt as of the end of 24, divided by, and I got $79. I think the stock's at 100, right? But I would argue this probably should be closer to 3. So you can see this is a great example of how, just changing the growth rate, the impact it actually has on your DCF, right? Now, my ability to get the terminal value growth rate for Starbucks is close to 0, right? You saw if I change it from 4% to 5%, like $58, let's say I use 5, now I get to $79, right? It's kind of insane. Let's just use one more. Here's Meta. And the key thing on Meta from a DCF perspective is what is the appropriate level of capital spending, right? They've already said they're going to be $50 billion in 2025, okay? That's the guidance, up from 18 or 19 billion in 2021. So again, if we do a DCF, we start with operating income, and one of the key assumptions is, right, how much capital spending, right? So I assumed 40 billion, saying that 50 billion is unsustainable. And I used a growth rate of 6%, social media, it's, multiple, right? So I got 580, right? And I think these two numbers are good. If I were to change this here to call it 60 billion, look what it does to my estimated stock price. Goes all the way from 550 to 350, right? So a big question that Meta shareholders, if you're valuing Meta, is what is the sustainable level of CapEx? Is it 60 billion or is it 40 billion, right? That's a big, you've got to do a lot of research, right, to actually get that right, right? And this is the advantage in doing a, great example of a reverse DCF, right? This tells me that, the sustainable level of CapEx is really going to drive Meta, whether I should invest in it or not. And so, but again, really hard. Is AI spending going to sustain forever at that high level? If that's the case, you shouldn't own the stock. But maybe these investments are going to tail off and they're going to go down. Any questions on the DCF? Boy, that was fast. Any questions? All right, let's move on to the next approach. Actually, let me... The next approach is the multiple of EBITDA, right? The enterprise value to EBITDA, right? So just as a precursor, my view is valuation is overrated as an exercise. The market is very efficient at valuing companies based on current information. Not enough time, too much time is spent on valuation, not enough time is spent on getting the inputs correct. The way you make money is by forecasting change, not having the perfect valuation model, right? And lazy investors rely on valuation, either not willing or do not have the talent to forecast fundamentals, right? And it's very hard to teach. I think after 8 or 9 years here, I think I finally have it down after a lot of trials and tribulations. No one measure works. You need to use a few and be flexible. And again, the valuation is useless if the inputs are wrong. And you need to constantly update your models and be reflective of current fundamentals. Literally, it's been 9 years. This is the first semester. I think I finally have a decent pitch down in terms of how to value companies. So if I think it's useless, why bother? It's important to understand what is implied in the valuation. Again, a reverse DCF, right? Is the market either too positive or too negative, right? So a common valuation tool is PE, right? PE is shit. We don't use PE. It's horrible, right? Anyone who uses PE, run. Okay, it doesn't take into account the capital intensity of the business, not cash flow based, easy to manipulate, encourages management to be short-term oriented in their thinking, doesn't take into account the balance sheet. Tax rate influences valuation, and you can't value companies that have no earnings. And really the big negative is that the company's capital structure will essentially drive the valuation. So you have two companies, let's say at the same level of earnings. Company A is highly levered, and company B has no debt. Well, company A is going to look expensive on a PE basis because interest expense is causing earnings to go down a lot, right? And so if you're looking at company A versus company B, company A that has all this leverage in its balance is going to look expensive on a PE basis versus company B that has no debt. So debt, right, capital structure actually does influence valuation, which is why PE is terrible. There are pitfalls with the DCF, mainly, right, is that the assumed growth rate is highly arbitrary and slight changes in it, right, yield huge changes to the enterprise value. And also, you cannot compare companies in the same industry in terms of valuation and related variables. We'll get to this shortly. But I think DCFs are great for analyzing projects internally within a corporate finance setting. And, if you think about it, it's very good if you have a beginning and an end and there's no terminal value period, right? So what are the drivers of valuation? Critical slide here, right? Great interview question. Why does company A sell at 20 times EBITDA and company B sell at 8 times? Well, return on invested capital, both the direction as well as the absolute level. Margins, the higher the margins, typically the better the business, right? Unit growth, companies that grow more should be valued higher. Management, right? Management does matter. Like if you look at Tesla's valuation, it's got the halo effect of Elon Musk, right? And the type of business and level of competition, right? But these first three are like huge drivers of valuation and explain why companies are valued differently. So the enterprise value to EBITDA, it's theoretically consistent with the M&M theory, takes into account the balance sheet, very cash flow focused. You can compare it across companies, and you can value companies that have no earnings. And again, we are comparing the enterprise value to EBITDA, right? we are indifferent with respect to how companies, it's an unlevered approach to valuation, which is consistent, right, across how we, actually analyze companies. The return on invested capital profitability measure, or measure of a good business versus bad business, is an unlevered approach to profitability. Same thing with this. Market value of equity plus net debt over EBITDA. EBITDA is defined as operating income plus depreciation. We do not add share-based compensation back to operating income, right? So we always, if you look at most companies, they will get their net earnings, and they'll add like 6 things back to get to, adjusted EBITDA. Most companies add share-based compensation. That's wrong, right? We assume share-based compensation as a cash expense. And so, so many times your EBITDA, your estimate of EBITDA for the most reported year is going to be different than what the company reports, right? So we calculate enterprise value using the year-end stock price, and we compare year-end enterprise value to the actual EBITDA, right? And we look at the multiple over time and whether it has changed, and we look to changes in growth and returns to understand the change in the multiple, right? So the disadvantage of it is it does not take into account the capital intensity of the business. Buffett, by the way, is very critical of this measure. It's one-dimensional because it does not equal free cash flow. And working capital and capital spending are not reflected in it. So this is his big criticism of it. But it is helpful. The last thing I want to, this is something new that I've used this year, is the unlevered free cash flow yield. And this ties directly into our calculation of free cash flow, what we've done before. And we're looking at free cash flow divided by the enterprise value of the company. This is, again, an unlevered approach consistent with the M&M theory, is comparable within an industry and across companies. Most companies today are valued between 3 and 5% free cash flow yield, right? And this is why some companies have such high EBITDA multiples. They are highly cash generative. So if you look at Apple, it's not really growing that much. Apple sells at like 20 times EBITDA, but its unlevered free cash flow yield is very high because it's very cash generative, right? So what we're doing is comparing the unlevered free cash flow yield to that of a 10-year treasury. And on top of the yield, we get essentially growth in free cash flow for free. And if we look at especially large tech, it reflects investors' perception that companies with a sustainable competitive advantage have a recurring cash flow that's fairly equal to what the 10-year treasury is. And on top of that treasury yield, we get growth in free cash flow. So we're going to use both approaches to, figure out how our company should be valued. We like to look at a historic range. And if we're going to argue for a multiple above this historic range, we're going to ask ourselves why. Why are returns getting better? Is growth accelerating? And we also, it's helpful to compare against other companies in the industry, right? And we always want to include key valuation metrics, returns, growth rate, and margins, right? And again, the most important factor is how sustainable is a company's competitive advantage. Ties directly to growth and margins. Today, most established companies trade between 8 and 12 times, right? But many companies trade above 12 times. And they're either a high growth company, they have very high returns, very high margins, right? And they're generating a lot of cash. But most companies are between 8 and 12 times today, right? Mature companies with, valuation, right? So what's important, right? So mature companies with limited growth opportunities, valuation it's really important, right? You're not going to really miss your valuation if next year's EBITDA is kind of easy to forecast. So, but companies that generate high returns and have large addressable TAMs, it's less important, right? As long as you get the direction right and you hold the stock, the valuation will essentially grow into itself, right? we tend to underestimate both the company's competitive advantage and the market size, and this is how we can miss big stocks, right? What looks expensive today is basically what looks is actually inexpensive a year later, right? Combination of growth and high returns, substantial value creation that accrues to shareholders. If you overpay initially, sometimes you can grow into its valuation. So let's look at a couple of examples here. First, on a comparison basis. This is like a really good example. Let us look at two companies in the online travel agency market, Booking.com and Expedia. So here are their metrics from the most recent quarter and for the most recent year. So Booking trades at 21 times its 2024 estimate, and Expedia trades at 11 times. Now, without looking at anything else, you would say, geez, Booking is expensive relative to Expedia, right? The multiple is 2x. So if you were just in, basic finance, you would say, oh, I'm going to short Booking and I'm going to buy Expedia. But now let's look at some of these metrics. Booking's EBITDA margin is much higher, right? Its ROIC is like way above Booking's, right? And its growth rate is higher. So now, if we look at these metrics, now we can start to understand why Booking trades at a premium to Expedia, right? Booking has higher growth, much higher margins, and demonstrably higher returns. It makes sense that its EBITDA multiple is much higher than that of Expedia. You could never, if you were pitching Expedia in your stock pitch competition next week for the BUFC, you would not say Booking trades at 21 times EBITDA, Expedia trades at 11. Expedia is going to go to 21 times EBITDA based on Booking's buy, right? You'd be laughed out of the room, right? So this is why I think DCFs fail, is that this is great information, right? You as an investor can look at Booking versus Expedia and understand the metrics that are driving Booking versus Expedia, right? You don't get this from a DCF, right? A DCF just gives you an answer. It gives you what the stock should be based on but you can't compare companies, within an industry. And here's another, which works for, sometimes they don't work perfectly. Let's compare Kimberly-Clark to Colgate, right? Colgate sells at 16 times enterprise value to EBITDA versus 13 for Kimberly. Well, why is that? Colgate has an ROIC greater than Kimberly. It has higher margins, and it has higher growth. Well, of course, Colgate trades at a premium to Kimberly-Clark, right? It makes sense, right? You could not pitch Kimberly-Clark saying, Kimberly-Clark should trade at the same multiple as Colgate, they're in the same industry. No, Kimberly should trade at a discount to Colgate. Now this is and again, this is, you don't have to worry about, this is like a valuation table that I like to put together for established companies. We start with the year-end stock price. We calculate the net debt from the balance sheet. We multiply the stock price times the shares outstanding from your income statement to get the market capitalization, again, based on year-end stock prices. Then we add net debt to market cap to get the enterprise value. Ignore invested capital. I'm not going to get into that. And here we can calculate, and here we're going to see our ROIC and how it has changed over time. And we're going to get our EBITDA multiple based on the enterprise value over EBITDA. And now we're going to see where has this company traded historically, right? And we're going to look at the unlevered, some of the stuff I cover in my classes, I'm not going to go through. And then we're going to look at the unlevered free cash flow yield. So the question is, we're going to look at margins, returns, and growth. And we have to ask ourselves, right? I always keep the stock price constant going forward just to see the impact on the multiple. So let's basically, historically, it's traded between 15 and 17 times, right? If we're valuing this company off of 2026, where should Garmin trade at, right? So there's a lot going on here, right? I have margins increasing and I have returns increasing, right? So I said, probably it should trade at 19 times, which reflects improving margins, improving returns, right? And a resurgence in its growth rate. And that was my justification for 19 times. I multiply this by my 2026 EBITDA estimate, which is operating income plus depreciation. We get to the enterprise value of $38 billion. We add our net debt forecast as of the end of 26. And we divide it by, and we discount it back. This is as of the end of 26. Today is 24. We discount that back 2 years. And we get a stock price pretty close to 210, right? Where it's trading today. So this basically says the stock looks fairly valued, right? So for me to get a stock price greater than this, I'd either have to argue for a multiple that's greater than 19 times. I think you'd be hard pressed to argue for a multiple based on its history above 19 times, or my EBITDA estimate's too low, right? So this, again, most stocks today are fairly valued. The market is ruthlessly efficient at valuing them. Let us look at Starbucks. Here is some of the stuff I didn't go over. We take our year-end stock price, multiply it by our shares outstanding to get the market capitalization. We calculate net debt. And then we divide our enterprise value by EBITDA, and we can, this 20 and 21 were COVID driven. So from 22, 23, and 24, this is where the company is trading. And the unlevered cash flow yield is actually not that great. So the question is, looking at returns and my assumption about growth, where should this company actually trade, right? So I use 16 times my 2026 EBITDA estimate of $6.8 billion. To me, right, growth is slowing, right? The company's getting bigger, and I have returns decelerating. I'm not going to pay 18, 19, 20 times. The company's financial characteristics are different. Growth is slowing. I have margins declining, and I have returns declining. So to me, 16 times is a reasonable estimate. We multiply this by our 2026 EBITDA estimate. We add in our 2026 EBITDA or subtract this to get our equity, discount it back, and I get a stock price of 76 versus 79 for my DCF. The other important thing to note is that these two valuation methods should be somewhat close, right? They should be, if they're way off by 30, 40, 50%, there's something wrong with either of them. Usually, my guess is your DCF is wrong, okay? So these two approaches should be, they're both theoretically the same, but there's something, you're doing something wrong if you get this here and this here. They should be fairly consistent. So any question, all these have been posted. Any questions on any of this? I just covered 6 weeks of class in 1 hour. Yes? Is there like a range you should be aiming for? Well, yeah, so what I like to look at the history, right? So the history, you have to understand that the market is probably pretty efficient, right? So I look at year-end enterprise value over year-end EBITDA. That gives me, that is known, right? There's no guessing that. So if we look at the range, and usually the range, usually the multiple lines up with returns are increasing, the multiple should expand. If returns are decreasing, the multiple should contract. But this is why having this table is actually helpful to seeing where has this company traded at historically. Now, if I had, all of a sudden I thought its margins were going to go from, there's a new 19% to 25%, and same-store sales growth are going to be 10%, I'd argue for a 21, a 21 multiple. But that isn't the case. Again, the other helpful thing to do is to compare it against another company in the industry. Chances are it's perfectly valued versus another company in the industry, right? But I like using the unlevered free cash flow yield. Here, let me pull up just as a last example. My friend's the one who turned me on to this unlevered free cash flow yield, and it just like unlocked. So here's Apple, right? Apple sells at, it just reported 20, well, they have it a weird. Apple trades at a gigantic multiple. This is historic. But if we look at its unlevered free cash, it actually makes sense that it trades at this level, right? So many times this unlevered free cash flow yield will inform you about how high the multiple actually is, right? It gives you a good sense of where the company should be. So normally you're like, 20 or 21 times, yes, its returns are high, but the company's growth is slowing. But when we add this other valuation measure, now it all makes sense, right? So yeah, Apple, I can kind of understand why it trades at a high level. The other company where you look at the multiple, you're like, that's insane, is Coke, right? Coke trades at a very high EBITDA multiple, but when you look at the unlevered cash flow yield, it actually makes sense. Any other questions? All right, you guys have been great. Thank you. I have no voice.